Hey, it's KP coming to you live from Newport Beach. Welcome to my home. We had so much fun and success last week with our video offsite in Culver City when you saw the house that me and my partner Jason and his wife Britt are all working on together. That we decided to do another offsite video here this week, an important week. But I think one of the things that's kind of unique about the video series is you're dealing with me that's helping you, and I'm inviting you into my home. This is my home, and most owners of lenders or C-level executives in our industry, not only do you not see them anywhere on social media, but you're rarely going to see them in your house. So kind of just a different approach. It's my approach, and I hope that the fact that I'm in my home at my kitchen table, it's a little messy. We cleaned it up for you. But the fact that we're here in the home, that it shows that I'm trying to be very frank and earnest with you and just tell it like it is and steer you in the right direction. So from my family to yours this holiday season, let's get cracking about what's going on. So we usually talk about the news of the week, and this is a super important news week. The Fed is going to speak on Tuesday and Wednesday. So Wednesday is the actual day where they come out, make a statement, and then they take question and answers from the reporters, which is generally unscripted. So the meetings, the Fed's Open Market Committee meeting is Tuesday and Wednesday. And we know, as our last couple of videos have talked about, there's a quiet period, and they've been very quiet leading up to this meeting. But that's not the only important thing that's going on this week. Tomorrow is Tuesday, the Consumer Price Index. Now, when we're looking back on this video, once it finally gets cut and published, we're gonna know whether inflation for prices that you and I pay for goods on a month-to-month basis went up or down. And there are a lot of components that go into it. A really big part of it is housing. And that's a big part of the CPI report. It's almost 40% of that entire report. And of course, there are other components that go into it. Remember, there's core, right? That excludes energy and food. And we'll talk about the energy component here a little bit later. Why does all this matter? Remember, the Fed is trying to tame inflation, the price that you and I pay for goods and services. We feel on this show that we've reached peak inflation, and I think most people feel that. So now all the talk about what the Fed is going to do, how much higher will they raise their federal funds rate? So the CPI report is very important, and then what they say, are they going to raise the Fed funds rate by 50 basis points, 75 basis points? Pause after this one? Are they going to hint at how high they'll go and how long they'll keep it? So when the Fed answers those questions, that statement is going to be important. And again, it could move the market. It could either impede or launch a Santa Claus rally. What's a Santa Claus rally? Typically at the end of the year, the stock market has a nice run. I'll get into that in just a second, what it takes. But the last piece of news of the week, other than the super important CPI report and the Fed Open Market Committee meeting, is going to be retail sales numbers. Now, retail sales is interesting this year. What will it compare to last year? That is, a big component of our gross domestic product, right? GDP in America, about 70% of it is made up by consumer spending. So did they spend this year? But most importantly, did they spend in the heaviest spending period of the year? We know that during the holidays, especially Black Friday, which we had a huge Black Friday, we had a record Black Friday, and an even bigger new record Cyber Monday. The retail sales numbers were huge for those days. And we know last year in COVID that we had a supply chain disruption and things were taking too long to get to you and us. And so people were ordering ahead of time. So we had a really big November. And is this November number going to be as big as last year? That will be a big telltale sign. So another thing to look at with that retail sales data that's coming out Friday, then starting to think about what December of this year will be like. Remember, a lot of companies either make or break their year from a profitability standpoint because of Black Friday. Does your profit and loss end up in the black profit or end up in the red, which is a loss? So black is a good thing on Black Friday. Even if the numbers are good for the last quarter of the year, what a lot of institutional investors are looking at are the guidance for the year going forward for Q1 of 23. As everyone starts to think about a recession, these earnings, especially for retail sales, which is information coming out at the end of the week, is super important. And I'm going to talk to you about who it's important to, institutional traders, and we'll talk about dark pools and who really moves the market which could end up causing a Santa Claus rally or not. Okay, so let's talk about the potential Santa Claus rally. What is it? Literally, the beginning of the taping of this video, we saw the market rally today. Now that's ahead of the consumer price index number coming out tomorrow. Inflation obviously is the talk of the town. The Fed's goal right now is to crush inflation. If you have inflation data continue to come down, you might see a Santa Claus rally. The conventional wisdom out there is that in 2023, that most companies, not all, most companies will start to feel the effects of more expensive credit, higher Fed funds rate, less buyers buying the goods and services out there. So we've seen a lot of these things happen where we might actually see a recession in 2023. We've heard from some of the biggest CEOs of banks in the world talk in recent weeks that they think that there might be a recession coming. So institutional traders are in charge of billions, bond traders in charge of trillions of dollars. They don't want to lose that money. If we have a Santa Claus rally here to end the month of December, it might be good. Don't know how much higher it can go because there's kind of a cap on growth right now because everyone is fearful of less growth next year, especially if there is an actual recession. People don't want to lose your money if they are managing your money for you, but they want to make you money too. And this is that seasonal time, the Santa Claus rally, where they make some money for clients. Me and my boy Corey here behind the camera, trading on our phones, we're just looking at stocks, looking at things, trying to make it better for our family. But we don't make the waves in the markets. We ride the waves that are made. Institutional traders, they're not trading on their cell phone. They're going to separate private exchanges. Some people dub them dark pools. They don't go to the New York Stock Exchange and I'd like to buy $10 billion of Apple today and press their button on their cell phone. They have separate exchanges. And your best barometer of seeing how institutional traders are thinking is watching the bond market, watching the 10-year treasury, watching the spread between 10 and 2-year treasuries. So we're gonna keep watching these institutional traders, see what they're thinking as all this data comes out. Again, it's very volatile. It's really tough being in the market and trading right now. But a Santa Claus rally can absolutely still happen. May not last as long as we think, may not even happen at all. But it's very data dependent. There's a lot of data coming out between now and the next couple weeks. Fingers crossed, we all love to have positive growth as we go into the new year. One of the components in inflation is energy, which is many different things, right? Heating oil for the winter, natural gas for the winter. These are things that, have a lot of volatility in them. So when you talk about inflation, and then there's core inflation. So we talk about the core number a lot. The price of energy goes up and down based on a war in Ukraine that comes out of nowhere. Right now it's going on the Strategic Petroleum Reserve of the United States. These are things that we don't really control. And again, it's very volatile from month to month. So the core readings of inflation tend to strip that out. The volatility of energy has to do with not just macro factors, but also seasonal factors. There's really two different times a year where you have like peak usage, which of course that demand will increase the price. This is a very extreme example of it. They are dealing with heating oil and gas, natural gas supply issues because of the war in Ukraine, with less supply out there. And especially now that parts of Europe have now instituted a cap. We're only going to buy oil from Russia for no more than $60 a barrel, which it hurts their pocketbook, puts a price cap on how much they're paying over there. But if Russia wants to sell that oil for a more expensive price, there's reports that I just listened to even this morning. They've got 100 tankers lined up in Russia to take their oil and go, fine, we'll go sell it to someone in China or India for a higher price. It's really cold in Europe right now. So heating oil, natural gas, these things, it's getting more and more expensive. And so back home here in America, maybe a less extreme version, but still something that's volatile. Because of the Ukraine and Russia war, we used here at home to fight the other cyclical part of peak pricing, the summer months. We used our petroleum reserve. It's called the Strategic Petroleum Reserve, right? When bars start to hit the road, they get in their cars, they start traveling in the summer, they're using gas. And that is the other end of the seasonal peak of energy usage in America. So you got the winter to keep warm, and you got the summer, specifically June, to make sure that you can travel. Here we are in December of 22, And the Biden administration is deciding to now refill that reserve. So there's a certain price point that if the price of oil comes down to, it's around $70 a barrel, right? What was interesting about today and last week and going into this week, which I don't think is a coincidence with the CPI report coming out and the Fed statement coming out, that right around $70, that floor, the Biden put, as in, hey, price comes down to this, we're buying because it's pretty cheap relative, that they're not going to let oil get below that. And we noticed even today that the price of oil firmed up. Biden put that floor around $70 a barrel. If you notice, is different than the $60 a barrel that Russia is being capped at by the European Union. So it's very interesting. These are all macro, political, geopolitical things that go on that we obviously don't control. So this core inflation reading is the real number we want to look at when the consumer price index number comes out this week. All right, I promised you to tell the difference between this recession and the Great Recession of '08, and really how all recessions are different and how it impacts housing. A lot of people look at the housing market crash in 2008, which was called the Great Recession. It impacted the entire global financial community. Literally around the world, they call it like the GFC, the global financial crisis. Well, here at home, we call it the Great Recession. Now that was based on poor credit. And we have to understand the difference between credit and a credit collapse like we had in '07, '08, and '09. And the difference between that inducing a recession versus any other recession. Every recession is different. Every recession is started for different reasons, right? So the Great Recession in 2008 was brought on because there were many loans and loan products and financial products created by Wall Street, created by the banks, created by the regulators, right? They're the ones that created the financial industry instruments that ultimately failed. The credit collapse of 2008 is why housing was in a, quote, bubble. So you cannot think that that market is what we're repeating in any other recession going forward. Remember, there's a difference between cash and then the credit extended to borrow money based on that cash, or in this case, based on house prices in 2006 and 7. You thought, if you were Wall Street, you thought that home prices would appreciate forever. And generally, they do over time. Homes appreciate about 5% a year over time. However, the bubble was created because of credit. Credit, loans extended where it was not credit worthy. We don't have that now. Trust me, I am part owner of a lender. We have a team of 2,200 employees servicing every community around the country, except for the state of New York, pending. But we'll tell you right now, the quality of loans are absolutely fantastic. People are being checked for their income and their assets and their credit. We re-verify it with the IRS, with their employer, with their banking institution. We pull their credit. We are managing risk now like never before. So the fact that we don't have a credit bubble right now means any kind of potential housing bubble isn't going to repeat like it did in '08. That we know. We do have a pending recession potentially happening. It's mostly because we had a wave of higher prices, which created a dollar money supply bubble sloshing around, chasing for too few goods, which is why the price of goods went up. And now we're deleveraging that because of federal money supply. The Fed money supply has come down. So it's now actual negative money supply. The Fed money supply is actually shrinking this year. And that's the first time it's happened in a long time. So then you start to look at this recession and how it looked like with other recessions in the past that were created by inflation. Every recession is caused by different things, and every recession impacts housing differently. Everyone thinks the word recession and they automatically think housing bubble, and that isn't always the case. So having said that, this little window here, this seasonal window where people kind of, hunker down for the winter, this might be a really advantageous window for you where there's less buyers out there competing for the homes that are on the market. Interest rates are coming down because of the Fed's actions. We've reached peak inflation. You might have cheaper money in the spring, therefore bringing more people to compete for that house. Think about that. All right, it's time to set up our 2023 predictions and projections. Don't hold me to it. It's just my thoughts with all the information available right now. Help us kind of think about what we want to go invest our money in as far as stocks, bonds, housing, anything else going into 2023. Let's go for a walk. So one of the predictions for 2023 is that there's going to be a ton of rehab getting done and beyond. So we have an aging housing supply right now. We've got about 85 to 90% of all homes that are sold are existing properties. So that means the properties are aging, and to get more modernized, they're going to have to get remodeled, like we see here in the background. This is a ton of just tremendous amount of business being done, not just in our neighborhood, but all over America. And you've got people living longer. So houses aren't coming on the market for sale as much. So this is a trend where, all the data, all the analytics is showing that there's going to be tons and tons of remodeling over the next 4 to 5 years at a really explosive rate. All right, let's finish up our 2023 predictions and projections. So hold me to it. I'm gonna be right on some, I'm gonna be wrong on some others, but this is just what I'm thinking here in December as we go into the end of the year. I think that interest rates and inflation have peaked. I think that is probably not quite conventional wisdom, but certainly in the thoughts of many, and I think will be confirmed pretty shortly here. So then all the thinking will be, all right, are we going into a recession? Now, I think we might have a mild recession. I don't think it'll be no recession, and I don't think it'll be a harsh recession. Recession really needs one more thing, and it's a horrible thing to talk about, but it's job losses. And we've seen the headlines with a lot of big tech companies out there laying off their employees. Now, tech companies, white-collar jobs, when they get let go, they tend to have some kind of severance. So still some money being paid there. So those numbers don't really show up. Those people don't show up in the numbers, the reports, and the data, because they're still getting paid some money, even though they're technically without a job. So I think the data will start to show more jobless claims and more people unemployed, which of course, if you don't have income coming in, then you don't have the money and the means to buy goods, and demand will come down. The Fed has stated this is the pain that they want. And so how much pain will they endure? I don't think they'll endure that much. I think that if we have a recession, I think it'll start and stop in 2023. Could it creep into 24? Maybe. How does that affect you and your money? If you're investing in the stock market, you have to think long term. Don't watch it every day. You're not a trader, you're an investor. So this is just one of those ups and downs that you roll with. Try and have a longer investment horizon. As it relates to housing, housing will stabilize as well. When interest rates come down, and they always do during a recession, that is really good for housing. Okay, so let's end all the predictions for 2023 right now. Subject to change with any new data coming out or anything that I don't see, a black swan event, a new war, a new pandemic, who knows what's gonna come. But the reality is, the first couple parts of this year will be rough in 23 for the stock market. But the housing market is a canary in the coal mine. They got us out of the recession first during the pandemic. They are in a recession now, and they will lead us out of any potential upcoming recession. So look to housing to see the direction how everything flows. Remember, about 64% of America owns a home, and that's the biggest asset and piece of their net worth. That's how wealth is created. So if people feel wealthy because of their home, because of appreciation and nested equity and that forced savings plan and that roof over their head, then they're gonna feel good about everything else. So look to a better second half of next year, certainly for housing, and that will lead the way for all other money markets. So I'm gonna leave with this. Your wealth is mainly made up by the largest purchase you make in your life. 64% of Americans are homeowners. If they feel wealthy, if they have equity, if they see that the appreciation or depreciation is stable or even trending up, they will feel better about money and investments in general. And that's good for stocks, bonds, housing, the broader economy, and our local economy. So I'll leave you with that for our predictions for 2023. Have a great one. Cheers.